everyone. Welcome to the latest Take 5 with Ryan and Sonu. Sonu, we're titling this one, The Fed is Done. You think about it, the Fed has been extremely aggressive, hiking interest rates. What did that do? Kind of upset the apple cart. But why did they do that? They did that to slow down the massive inflation that we've been seeing. So all those interest rate hikes have kind of been a headwind. They kind of, we had a bear market last year. Stocks are doing good this year, but we've had some indigestion here and there. We just had, Sonu, some inflation data. Again, inflation is very, very important as it pertains to if the Fed's going to keep hiking or not. Talk to me about this inflation data that we just saw, and again, which confirms, hopefully, the Fed is done hiking.
I like the word you use, confirms, because, we've been talking about this for a while. It's just that the data's taken a little while to catch up to our expectation, right? And there was good reason to expect that inflation would continue to go down, as you and I have been talking about for several months now, if not almost a year. But this is the first report that we saw broad-based disinflation across the board, right? Headline inflation has pulled all the way back from 9% to about 3.2% as of October. And that's come on the back of lower energy prices. Gas prices are going down. That's good for the economy and consumption, right? That's good for, households. They have more money in their pockets. They're spending less on gas. That's a good thing. But the Fed ignores that. The Fed says, you know what, we're not looking at gas prices because it's too volatile. We don't know what to do with it. We're looking at something called core inflation. So we're stripping out food and energy. Right. But here's the thing, Ryan, core inflation is also slowing, right? In October, it rose just 0.2%. That translates to a 2.8% annualized pace, right? Over the last 6 months, core CPI, core consumer price index inflation, running just above 3%. Last year, this time, we were looking at 6 to 7%. So that's slowing down significantly. And this probably puts, a nail in the coffin, so to speak, for any further rate hikes. We're not going to talk about further rate hikes. In fact, the opposite. We're going to start talking about rate cuts, right? Because to your point, the Fed raised rates from 0 to 5.5% because inflation rose to 40-year highs. And if inflation's pulling back, why keep policy rates that restrictive? They can start easing.
Yeah, you're right. I mean, that's the big question, and we'll talk more about that as we get into next year. But the bottom line, we think the Fed is done hiking. So we took a look at the last 10 cycles where the Fed hiked rates, then they stopped hiking. Again, that's likely where we are now. 1 year later, the S&P 500 was up 8 out of 10 times with an average return a year later of about 14%. So the last hike this time was back in July. So again, there are some reasons to think that if the Fed was a headwind before, 40-year highs in inflation were a headwind before, all the supply chain issues were headwinds before, those things are quickly becoming tailwinds. So let's talk about the idea of a rate cut, though, because what we've heard, I know a lot of listeners and viewers of this video probably remember when the Fed cut, it was like financial crisis, 100-year pandemic, and the tech bubble, right? So in bad times, but when the Fed cut before, it wasn't good. You're telling me they might cut, but the economy can withstand it? How does that square that circle for me?
So the best news out of all of this is inflation's coming down even as the economy's accelerated over the last year, right? Over the last year, economic growth, real GDP growth, so after adjusting for inflation, it's coming around 2.9%. That's above the trend of about 2.5% we saw over the last decade, right? But then inflation slowed, just like I said, from 9% to just over 3%. And look, the Fed raised rates to 5.5% when inflation was running about 9%. Yeah, of course you would do that because you want to tighten rates, you want to tighten policy, you want to pull things back. And here we are with inflation running around 3%. If they keep rates at 5.5%, wait, that's too tight, right? Let's pull it down to maybe 4.5%, right? Sometime by the middle of next year, maybe even through the end of next year. But, the economy, think of what that does to the economy, right? If rates go down, that's going to pull, first thing, mortgage rates down, right? That's going to unlock housing activity. So we're in a very different cycle where the Fed cutting rates is going to spur more activity, and that's going to be positive for the economy.
No, absolutely. You talk about this economy. I mean, the consumer continues to spend, jobs continue to gain, manufacturing has been good, solid. Housing could be a real wild card if mortgages continue to go lower, like we're seeing with yields globally really sinking here. Those are all positives. Again, so we do not see a recession next year. We see an economy that continues to grow. We've been overweight equities. We think this bull market's alive and well. And with the fact that the Fed is likely done cutting, It's kind of a nice bow on top, again, for potentially a strong year-end rally. But honestly, maybe even into next year, we could continue to see some gains. So thank you for watching this week. We'll see everybody soon on the next Carson Take 5. See you then. Take care.